$90 to 73 in 120 minutes. While the business world slept, a 22% collapse unfolded across Shanghai's trading floors. 3 million ounces vanished from COMEX vaults on Tuesday. Physical metal flowing out, yet prices crashing down. The contradiction that should concern every decision maker watching this. A $10 premium still holding in Chinese markets, while Western exchanges recorded one of the most violent precious metals events in modern financial history. This wasn't a correction. This was calculated. And what happened in those 2 hours may signal something far larger than silver itself. Welcome to Market X-Ray, where we examine the anatomy of financial events that shape your business decisions. Now, if you've accumulated some wisdom over the years, perhaps you're beyond 50, you understand that truth in markets isn't found in headlines, it's found in data. So let me ask you something important. Would you help us by pressing that subscribe button? Not for algorithms, but because serious economic analysis deserves a community of serious minds. And tell us in the comments, from which corner of the world are you watching this analysis unfold? London, Singapore, New York, Lagos? Because what happened to silver in those 2 hours affects every market, everywhere. Now, let's dissect exactly what occurred. On the morning of a seemingly ordinary trading day, silver traders across Asia opened their screens to witness something unprecedented. Within a span of 120 minutes, silver prices collapsed from $90 per ounce to $73, a 22% freefall that sent shockwaves through global financial markets. The epicenter of this collapse was the Shanghai Futures Exchange. While Western traders were still processing overnight data, Chinese markets were already experiencing what analysts would later describe as one of the most violent precious metals events in recent history. The speed was alarming, the volume was extraordinary, and the timing raised questions that extended far beyond technical analysis. When observers examined the price differentials across global markets, they discovered something peculiar. Shanghai spot prices held at $86. Shanghai futures were trading at $90. Meanwhile, Western spot markets sat at $75. And Western futures at $76. A $10 premium existed between Chinese and Western markets, and this premium persisted even as prices crashed. This divergence was not normal market behavior. In efficient markets, arbitrage opportunities of this magnitude typically disappear within minutes. Professional traders exploit price differences instantly, yet here was a $10 gap, holding firm, defying the fundamental principles of price discovery that govern modern financial systems. Gold, silver's precious metal counterpart, told a different story entirely. While silver experienced its violent descent, gold remained relatively stable at $48.21 per ounce. The contrast was stark. Two metals, both considered safe haven assets, both traded on the same exchanges. Yet one collapsed while the other held steady. This divergence demanded explanation. Market analysts immediately began examining trading volumes during the 2-hour window. What they found was extraordinary. The volume of silver contracts traded during the collapse exceeded typical daily averages by multiples. Liquidity, which should have stabilized prices, seemed instead to accelerate the downward momentum. Order books showed massive sell orders executing in rapid succession, each one driving prices lower, creating a cascade effect that overwhelmed buy-side interest. The mechanics of the collapse revealed something critical about modern market structure. High-frequency trading algorithms, designed to react to price movements in microseconds, amplified the decline. When silver broke through key technical support levels, these automated systems triggered additional sell orders. Human traders, watching their screens in real time, found themselves unable to intervene effectively. The speed of algorithmic execution had fundamentally changed the nature of market crashes. Institutional positioning data painted an interesting picture. Large commercial traders, those with the deepest pockets and longest time horizons, had been reducing their long positions in silver for weeks prior to the crash. The data was public, available to anyone examining commitment of traders' reports. Yet most retail participants ignored these signals. They focused on price momentum, on the excitement of silver approaching $90, rather than on the structural positioning of major market participants. Historical context provided perspective. Silver had experienced similar crashes before. In 2011, silver fell from nearly $50 to $35 in a matter of days. In 2013, another violent decline shook investor confidence. In 2020, during the initial pandemic uncertainty, silver experienced flash crash conditions. Each event shared common characteristics: extreme volatility, algorithmic amplification, and subsequent investigations that revealed market structure vulnerabilities. But this crash was different in one critical respect. The physical market was behaving independently from the paper market. While futures contracts crashed in price, physical silver dealers reported something unexpected. Demand remained strong. Premiums on physical coins and bars actually increased in many jurisdictions. The disconnect between paper prices and physical reality was widening. Financial regulators monitoring the situation faced a familiar challenge. Global silver markets operate 24 hours across multiple jurisdictions. Shanghai's trading hours overlap minimally with London and New York. This creates surveillance gaps. What appears as natural price discovery in one market might be something else entirely when viewed across the entire global trading ecosystem. The liquidity profile during those 2 hours revealed another dimension of the event. Bid-ask spreads, normally tight in silver markets, widened dramatically during the crash. This indicated that market makers, the institutions responsible for providing continuous liquidity, had stepped back. Without their participation, even modest sell orders could move prices significantly. The withdrawal of liquidity, at the precise moment when it was most needed, transformed a decline into a collapse. As the dust settled and silver found temporary stability in the mid-70s, traders and analysts began asking the essential question: was this crash a natural market correction, or was something else at work? The answer would require examining events that occurred in the days immediately preceding the collapse. Events that suggested this outcome was not entirely unexpected by those watching the right indicators. The physical evidence told a story that contradicted the price action entirely. 3 days before silver's dramatic collapse, something unusual began unfolding in the vaults beneath Manhattan's financial district. The movement was silent, methodical, and massive in scale. Those who understood the significance of vault activity were watching carefully. Those who didn't would soon learn an expensive lesson about the difference between price and value. Tuesday's COMEX vault reports revealed an extraordinary event. 3 million ounces of silver had been withdrawn in a single day. To contextualize this number, imagine the equivalent of 93 tons of physical metal being removed from the world's most important precious metal storage system. This wasn't routine activity. This was a coordinated extraction on a scale rarely witnessed in precious metals markets. The breakdown of these withdrawals told a story of institutional intent. Asahi, one of the world's largest precious metals refiners, withdrew nearly 2 million ounces. HSBC, a banking institution with deep roots in Asian precious metals markets, removed over 900,000 ounces. JPMorgan, a name that appears repeatedly in precious metals market history, withdrew 282,000 ounces. These weren't retail investors moving household savings. These were sophisticated entities with access to information and resources beyond typical market participants. But the withdrawals represented only part of the vault activity story. Another 2.5 million ounces were adjusted into LBMA registered category. This technical reclassification matters more than most observers realize. Registered silver represents metal available for immediate delivery against futures contracts. Eligible silver sits in vaults, but cannot be delivered unless reclassified. The movement of metal into registered status typically indicates preparation for delivery, or anticipation of delivery demands. The total COMEX silver inventory had declined to 400 million ounces. Historical analysis showed this level hadn't been reached in years. The trajectory was clear. Physical metal was leaving the system at an accelerating rate. Yet simultaneously, paper contract open interest remained elevated. The ratio between paper claims and physical metal was stretching wider. Something fundamental was shifting in the relationship between derivatives markets and underlying physical assets. Technical analysts studying silver's price action during the preceding week noticed a pattern emerging. The $87 to $90 zone had become a battleground. Silver approached $90 3 separate times. Each attempt resulted in rejection. Each rejection closed with prices below the resistance level. Bodies closing beneath key technical thresholds indicated that selling pressure intensified whenever silver threatened to break above $90. What made these rejections particularly noteworthy was the consistency of the selling. The pressure didn't appear random or emotional. It arrived precisely as prices touched specific levels. Volume spikes accompanied each rejection. This suggested institutional participation rather than retail panic. Someone, or multiple someones, had determined that $90 represented an unacceptable price level. They defended that line repeatedly until finally breaking it downward with overwhelming force. Options market data revealed another layer of the pre-collapse positioning. Strike prices clustered heavily around $85 and $90. These clusters represented billions of dollars in notional value. Options expiry schedules showed significant contracts set to expire within days of the crash. The timing was precise. Those holding short positions at $90 strikes stood to profit enormously if silver remained below that level at expiry. Those holding long positions faced substantial losses if prices declined sharply before expiration. Commitment of traders data, published weekly by regulatory authorities, showed commercial traders had been steadily reducing long positions while increasing short positions. This data was public. It was available to anyone willing to examine it. Yet the broader market sentiment remained bullish. Retail traders continued accumulating long positions through ETFs and futures contracts, even as the largest commercial participants were positioning for decline. The contradiction between physical market behavior and paper market pricing intensified during this pre-collapse period. Physical dealers reported increased premiums on coins and bars. Delivery delays extended from days to weeks in some jurisdictions. Refineries operated at capacity. Industrial users of silver expressed concerns about supply availability. Every physical market indicator suggested tightness, scarcity, increasing demand against constrained supply. Yet the futures market told the opposite story. Open interest remained high, indicating abundant paper silver. Liquidity appeared deep. Trading volume suggested easy entry and exit. The paper market operated as if silver were plentiful, while the physical market behaved as if silver were scarce. This disconnect had been widening for months, but in the days before the crash, it reached levels that defied rational explanation. Currency markets provided additional context. The US dollar index had been strengthening incrementally throughout the preceding weeks. Precious metals typically move inversely to dollar strength. As the dollar rises, metals priced in dollars become more expensive for international buyers. This dynamic creates natural selling pressure, but the magnitude of silver's eventual decline far exceeded what dollar strength alone could explain. The final piece of the puzzle lay in algorithmic trading patterns. Analysis of order flow in the 72 hours before the crash revealed increasing participation by high-frequency trading systems. These algorithms operate on pattern recognition. When they detect specific technical formations or volume signatures, they execute predetermined strategies. Their presence had grown substantially, positioning them to amplify any significant price movement that might occur. All these elements converged simultaneously. Physical withdrawals, technical rejections, options positioning, commercial trader behavior, physical paper disconnect, currency dynamics, and algorithmic preparation. Individually, each factor carried meaning. Collectively, they painted a picture of impending volatility. Those monitoring these indicators knew something significant was approaching. They just didn't know exactly when it would arrive. Beneath the surface of silver's violent collapse lay a complex architecture of interconnected markets, each operating under different rules, different time zones, and fundamentally different philosophies about what constitutes value. Understanding this architecture reveals why a 2-hour price crash could occur while physical metal simultaneously commanded premium prices across continents. The Shanghai-London-New York pricing triangle represents the backbone of global precious metals markets. Each city operates its own exchange with distinct characteristics. Shanghai trades physical contracts requiring actual metal delivery. London operates primarily through over-the-counter transactions between major banks and dealers. New York's COMEX functions largely through cash-settled futures, where physical delivery remains possible but uncommon. These three markets should theoretically maintain price equilibrium through arbitrage. When prices diverge beyond transaction costs, traders profit by buying in the cheaper market and selling in the expensive one. Yet during silver's collapse, this arbitrage mechanism failed spectacularly. The $10 premium between Shanghai and Western markets persisted far longer than market efficiency theory suggests possible. This wasn't a momentary dislocation lasting seconds or minutes. This was a sustained divergence lasting hours. Several explanations emerged among market analysts, each revealing different dimensions of structural market stress. China's silver premium carried strategic implications extending beyond simple supply and demand. Chinese entities, both governmental and private, had been accumulating physical precious metals systematically for years. This accumulation served multiple purposes. It provided industrial supply for China's massive electronics and solar panel manufacturing sectors. It offered portfolio diversification away from dollar-denominated assets. It represented a form of monetary insurance against currency instability. The premium Chinese buyers willingly paid signaled their assessment that physical metal possessed value exceeding paper market prices. This divergence illuminated a deeper question about precious metals markets. What is the true price of silver? Is it the price discovered on futures exchanges where leverage ratios reach 100 to 1? Or is it the price physical buyers pay when acquiring actual metal for delivery? Traditional financial theory suggests these prices must converge, yet increasingly they diverged. The paper-to-physical ratio in precious metals had reached levels unprecedented in modern markets. Estimates suggested that for every ounce of physical silver available for delivery, somewhere between 100 and 500 paper claims existed through various derivative instruments. This ratio meant that if even a small percentage of paper contract holders demanded physical delivery, the system would face severe stress. The math was straightforward. The implications were profound. COMEX delivery mechanics added another layer of complexity to this structural foundation. The exchange maintains two inventory categories. Registered inventory stands ready for immediate delivery against futures contracts. Eligible inventory sits in approved vaults, but cannot be delivered unless reclassified as registered. This distinction matters enormously during periods of delivery pressure. When longs demand physical metal, only registered inventory satisfies those demands. The process of converting eligible to registered requires vault operator approval and can take time. In the months preceding the crash, registered inventory had declined while eligible inventory remained relatively stable. This suggested vault operators and metal owners were reluctant to make metal available for delivery. They preferred holding it in eligible status where it couldn't be claimed against futures contracts. This preference indicated their belief that physical metal held more value than current market prices suggested. Central bank policy influenced precious metals markets through multiple transmission mechanisms. Federal Reserve interest rate decisions affected opportunity costs of holding non-yielding assets like silver. When interest rates rise, bonds and savings accounts offer returns that precious metals cannot match. This creates selling pressure on metals. And when rates fall or remain low, precious metals become relatively more attractive, beyond interest. But central bank influence extended beyond monetary policy into market structure itself. Major financial institutions acting as market makers in precious metals maintain close relationships with central banking systems. These banks participate in mechanisms that allow official sector entities to influence market conditions through legitimate channels. Whether such influence occurred during silver's crash remained unknown to outside observers, but the structural capacity for such influence existed within the regulatory framework. Silver's dual nature as both monetary metal and industrial commodity created unique supply-demand dynamics. Unlike gold, which serves primarily as a store of value, silver serves essential industrial functions. Electronics manufacturing consumes vast quantities. Solar panel production requires silver for photovoltaic cells. Medical applications utilize silver's antibacterial properties. Photography, though declining, still uses silver. Water purification systems incorporate silver components, and this industrial demand provides a price floor based on manufacturing needs. Yet silver also functioned as monetary metal throughout human history. This monetary role persisted in modern markets through investment demand for coins, bars, and exchange-traded products. The tension between industrial and monetary demand created price volatility exceeding most commodities. Industrial users require steady supply at predictable prices. Monetary investors seek appreciation and store of value. These competing purposes pulled silver prices in different directions simultaneously. Mining production costs establish theoretical price support levels. When silver prices fall below production costs, miners reduce output or shut down operations entirely. This supply reduction should eventually support prices. Current estimates placed average global silver mining costs between $18 and $22 per ounce. At $73, silver remained well above production costs, suggesting the crash hadn't reached levels threatening supply disruption. However, primary silver mining represented only a portion of total supply. Approximately 70% of silver production came as a byproduct of copper, lead, and zinc mining. These operations continued producing silver regardless of silver prices, because their economic viability depended on base metal prices. This structural characteristic meant silver supply remained relatively inelastic to price changes, creating potential for sustained price volatility. Exchange-traded fund flows provided real-time indicators of investor sentiment. During the crash, some ETFs experienced outflows as investors liquidated positions, yet physical-backed silver ETFs reported something curious. Their inventory levels remained stable or even increased slightly. This suggested that while futures traders sold paper contracts aggressively, physical metal investors held positions or added to them. The divergence between paper and physical behavior continued manifesting across multiple market segments. Margin requirements in futures markets played a critical role in amplifying volatility. Traders could control large silver positions with relatively small capital deposits. When prices moved against leveraged positions, margin calls forced liquidation. These forced sales created cascading effects. Initial declines triggered margin calls. Margin calls forced selling. Forced selling pushed prices lower. Lower prices triggered additional margin calls. The cycle repeated until either prices stabilized or leveraged positions were fully liquidated. Regulatory surveillance capabilities struggled to maintain effectiveness across global 24-hour markets. An event originating in Shanghai during Asian trading hours might conclude before Western regulators arrived at their offices. The fragmented nature of global markets, operating under different jurisdictions with varying regulatory standards, created opportunities for activities that might not survive scrutiny in more transparent environments. The precedent of previous precious metals manipulation cases provided historical context. Major financial institutions had been fined billions of dollars for manipulating gold and silver markets through spoofing, layering, and coordinated trading activities. These cases established that manipulation had occurred. They demonstrated that major institutions possessed both capability and willingness to influence prices for profit. Whether similar activities contributed to this particular crash remained unknown, but the historical record confirms such activities existed within the realm of possibility. As silver prices stabilized in the mid-70s, market participants faced a fundamental question. Were they witnessing natural market forces reaching equilibrium, or were they observing the outcome of calculated actions by entities with resources sufficient to move markets? The answer would determine how the business community should interpret this event. When markets experience violent dislocations of the magnitude witnessed in silver's 2-hour collapse, the immediate question facing business leaders extends beyond the metal itself. The event serves as a stress test, revealing vulnerabilities in broader financial architecture. Decision makers must assess whether this represents an isolated precious metals event or a signal of deeper systemic fragility requiring strategic response. Risk assessment frameworks employed by sophisticated institutions categorize market events along a spectrum. Normal volatility falls within expected parameters based on historical data. Standard deviation calculations capture typical price movements, but events like silver's 22% crash in 2 hours exceed these statistical boundaries. They represent tail risk, the kind of market behavior that occurs far less frequently than normal distributions predict, but carries disproportionate impact when it manifests. The persistence of the $10 premium between Chinese and Western markets after the crash signals something strategic analysts must consider carefully. Price divergence of this magnitude indicates market segmentation. When markets segment, the assumptions underlying portfolio diversification strategies require re-examination. If physical and paper markets can diverge this dramatically, then positions in paper derivatives may not provide the hedge or exposure investors believe they possess. For businesses maintaining treasury operations with precious metals allocations, this event demands a fundamental review of counterparty risk. Futures contracts represent promises to deliver metal at specified prices, but promises depend on counterparty ability and willingness to perform. During extreme market stress, counterparties face their own survival pressures. The gap between contractual obligations and actual performance widens precisely when it matters most. Physical possession eliminates counterparty risk entirely. Paper claims multiply risk through layers of intermediaries. Industries dependent on silver for manufacturing face a different calculation entirely. Electronics manufacturers, solar panel producers, and medical device companies require steady physical supply at predictable costs. The violent price volatility in the physical paper market disconnect create supply chain uncertainty. When paper prices crash, but physical premiums rise, procurement strategies based on futures market pricing become unreliable. Companies must decide whether to secure physical inventory during price dislocations or risk supply interruptions if physical markets tighten further. The currency hedge question takes on new dimensions when traditional safe haven assets demonstrate this level of volatility. Businesses operating across multiple currencies typically maintain precious metals positions as insurance against currency devaluation. But insurance becomes questionable when the insurance instrument itself experiences crashes exceeding the risks it is meant to hedge against. Gold's relative stability during silver's collapse suggests differentiation between precious metals matters more than generic precious metals exposure in portfolio construction. Institutional investors managing substantial capital face a philosophical question about market structure itself. If algorithmic trading systems can amplify a decline from $90 to $73 in 2 hours, what prevents similar dynamics in other asset classes? The mechanisms that accelerated silver's crash exist throughout modern financial markets. High-frequency trading, margin requirements, stop-loss cascades, and automated risk management systems operate across equities, bonds, currencies, and commodities. The vulnerability demonstrated in silver markets reflects broader systemic characteristics. Long-term structural trends provide context for interpreting this event within larger patterns. De-dollarization efforts by major economies have accelerated. Central banks globally increased gold purchases to record levels. Trade settlements increasingly occur in non-dollar currencies. These trends suggest growing skepticism about dollar-based financial architecture. Precious metals represent alternatives to this system. But the violent volatility in silver markets demonstrates that alternatives carry their own risks and uncertainties. The comparative behavior of gold and silver during this event offers analytical insights. Gold, with deeper liquidity and broader central bank participation, maintained relative stability. Silver, with thinner markets and greater industrial demand components, experienced extreme volatility. This divergence suggests that market depth and participant diversity provide stability that shallow markets cannot sustain during stress. For decision makers considering precious metals allocations, the choice between metals carries implications beyond simple price exposure. Market timing versus strategic accumulation represents a tactical decision every business treasury function must address. Attempting to time market bottoms and tops requires accurate prediction of future price movements. Strategic accumulation focuses instead on building positions over time, regardless of short-term volatility. The evidence from this crash suggests that those attempting to time markets faced severe challenges. Prices moved too quickly for human reaction. Those accumulating strategically had opportunities to add positions at sharply reduced prices. Regulatory environment outlook affects how businesses should interpret and respond to this event. Authorities faced immediate pressure to investigate whether manipulation contributed to the crash. If investigations reveal misconduct, regulatory changes typically follow. These changes might include increased margin requirements, position limits, enhanced surveillance, or restrictions on certain trading strategies. Each regulatory response carries implications for market liquidity, trading costs, and price discovery mechanisms. The entrepreneur's decision matrix for operating capital allocation becomes more complex after witnessing such volatility. Business operations require predictable cost structures. Excessive commodity price volatility creates planning difficulties. Companies must decide whether to hedge commodity exposure through derivatives markets or accept spot market pricing risk. The silver crash demonstrated that derivative hedges themselves carry execution risk during extreme volatility. Basis risk, the gap between hedge prices and spot prices, can widen dramatically. Historical recovery patterns from similar precious metals crashes provide probabilistic guidance rather than certainty. After the 2011 silver crash, recovery took years. Prices never returned to the previous high. After the 2013 decline, silver remained depressed for extended periods. The 2020 flash crash recovered relatively quickly. Each event occurred in different macroeconomic contexts with different underlying causes. Pattern recognition helps frame possibilities but cannot predict outcomes. Monitoring systems and indicators for future volatility events become critical infrastructure for businesses with precious metals exposure. COMEX vault inventory reports provide advance warning of physical market stress. Commitment of traders. Data reveals positioning by major market participants. Technical resistance levels identify price zones where selling pressure concentrates. Options, market data shows where significant financial interests cluster. Currency correlations help anticipate precious metals pressure from dollar movements. These indicators, monitored systematically, provide early warning of developing market stress. The actionable intelligence emerging from this analysis requires integration into strategic decision-making processes. Businesses must establish clear policies governing precious metals exposure. These policies should specify physical versus paper allocations, position sizing limits, rebalancing triggers, counterparty selection criteria, and stress scenario responses. Written policies prevent emotional decision-making during market volatility. They ensure consistency and accountability in treasury operations. The final analytical assessment returns to the fundamental question posed throughout this examination. Was silver's crash an isolated correction, a technical shakeout of over-leveraged positions that clears the way for stable price discovery? Or does it signal systemic stress, a warning that deeper fragilities exist within financial market architecture? The evidence suggests elements of both. Technical factors clearly contributed. The $87 to $90 resistance zone, over-leveraged long positions, options expiry pressures, algorithmic amplification. These factors alone could produce violent price movements. But the physical market behavior, the vault withdrawals preceding the crash, the persistent premium in Chinese markets, the divergence between paper and physical pricing, these elements suggest something beyond mere technical correction. They indicate fundamental questions about market structure, price discovery mechanisms, and the relationship between financial claims and physical assets. For business decision makers, the prudent response acknowledges uncertainty while preparing for multiple scenarios. Maintain precious metals exposure for its strategic diversification benefits, but recognize that volatility may increase rather than decrease. Favor physical holdings over paper derivatives where feasible. Monitor indicators providing advance warning of market stress. Establish clear policies, preventing emotional responses during volatility. Accept that markets increasingly demonstrate behaviors exceeding historical patterns. The 2-hour crash that took silver from $90 to $73 represents more than a price movement. It represents a revelation about the nature of modern financial markets. Those who understand this revelation can position themselves strategically. Those who dismiss it as mere volatility may find themselves unprepared when similar dynamics manifest in other markets. At times when their exposure carries greater consequences. The physical metal continues flowing out of vaults. The premium in Eastern markets persists. The contradiction between paper prices and physical reality remains unresolved. These conditions suggest the story of silver's volatility has not yet concluded. It has merely entered its next chapter.